Hi, I'm Keith McCullough. Welcome back. I want to talk about the jobs report. I want to talk about the economic implications of what's going on in the actual job market. And I also want to give you kind of some of the market read-throughs, what you should be doing in the face of a down dollar and rising inflation. But first, just to get into the jobs report, let's just kind of get into the wood. Let's not talk around issues. Let's go right at the issue. Non-farm payrolls on a 3-month rolling basis continue to deteriorate. This is only 3 months old, so again, this is relatively new. What's more new is the non-seasonally adjusted rolling claims data series, which we look at on a year-over-year basis. Now, when I say that, that sounds like a mouthful because it is, and that's why you don't hear people talk about this way. This is how we model it, and we think this is the only model that really matters as a leading indicator. So what you can see here is that the last 8 jobless data points, and again, you get this number every Thursday, so the number yesterday mattered more than today's, they've deteriorated. Now again, you can look at this visually. What we show you is non-seasonally adjusted jobless claims. It's a degradation in the improvement. So again, that's Hedgeye style. We talk about the second derivative, or the rate of change. So you can see that really we've been telling you that the jobs picture has been really getting less good for the last 8 weeks. And again, that's a problem, and it's a new problem that I don't think that the Fed completely understands. Now the next question is, what is the Fed going to do about it? And to answer that loaded question, I have to go back to history. Now, the history is the Federal Reserve Act, the Federal Reserve Act of 1913 being the mandate, the dual mandate, which is A, full employment, and B, price stability, has been effectively, at this point, abandoned. Now, most people are going to be, what? What's happening? Yes, it's been abandoned. They don't actually do this stuff anymore. What they do is they target interest rates. In other words, they price fix the curve. So under any data, inflation and or employment, or the lack thereof in either, they're not going to really do what they should be doing. Now, what they should be doing is, it's really simple. Under a full employment situation, as you go from 10% unemployment to 8 to 6.5, the Fed should be getting tighter. Now again, that's what they should be doing. They're not obviously doing that. They didn't do that. In the face of inflation accelerating, they should also be getting tighter. But they have really no intention of doing that. So again, that's the point. You can see this on this final slide that I'm going to hit on. What the Fed is actually doing is that they're changing the goalposts on unemployment. So again, they had a 6.5% unemployment rate target that they'd get tighter on. But Bill Dudley said yesterday, well, that's kind of obsolete. Go eat an iPad. I mean, seriously, guys, at this point, the world doesn't believe you anymore. That's why the chart of the U.S. dollar is going straight down. And then finally, on the inflation point, the bond market is effectively assigning 0% credibility, 0%, which is in line with the Fed's, really with the Fed's policy, which is kind of interesting. But the Fed has no credibility on fighting inflation. So in other words, as the market starts to acknowledge that we have a weak dollar policy, the Fed is going to say, well, we don't mind 2% inflation. So the dollar will go lower, inflation will go higher, and what happens when the dollar goes lower and inflation goes higher? The purchasing power of Americans goes down, and U.S. growth slows. So that's our call. We're sticking to it. If you have any questions, please ping me. @Keith McCullough is my Twitter handle.